first take a look at the wave. There is a 1, 2 here, right? There is a 3, there is a 4, rejects. The points of rejections are very important, that they are the candle close and not the candle tail. So we have a 4 here, right? That's it. This is wave 5 in white that's going down. We did an internal 1, 2. There was a 3. Now this is a very important test, and it showed that the market is bearish. These are candle hair lines, and the candle closes always below the candle body for level 1. This is wave 4. That was the correction, right? You can have it a 4A and a B and a C, no problem. What we're looking now is a wave 5, because there has been failure. Why can I confirm that there is failure? Because there is negative momentum continuation in the 4 hours. Very strong. This is a wave 4 rejection here, that trigger. This, sorry for not using an arrow, this is a wave 4 rejection, that trigger. And we also have negative momentum on the 1 hour. We have 2 consecutive intermediate term negative momentum cycles supporting our short trade. This is the 1 hour chart, negative. Alright, and that's just what we want to see. Excellent opportunity then. And of course, I don't need to look at the day and the higher degree time frames. Simply, they have been stuck into negative territory for a long time. So let's just look at them before. Consistently negative on the day, right? And still, of course, trying to be contained to level 1 on the weekly chart. We have 2 interesting additions here today. The first of which is we should be taking projections on that weekly chart. If there's going to be a level 1 on the weekly chart, we're looking at some kind of a neckline that is going to be tested. So this is really very clear, but if we have a degree 1, this is a degree 1, still has room to run to overbought. We have negative momentum, remember, on everything else, on the daily, on the 4 hours, on the 1 hour, everything is negative, so it will push it down, push momentum here down, and that is your wave 5. And you need to be looking for a neckline. Next neckline is too low, so we're just looking at the 200-point moving average. 22,000 and 20,000 and 18,000, spiking into 18,000. The next addition we should be making is on the daily. Maybe we should be doing this as of next week. It appears on this daily chart that we are really, this is the daily chart, we have been implementing an unsuitable strategy. But we don't really tell what we could. So this strategy shows that you're inside of a triangle. In reality, there is a center line here. Right, so we're bearish. Once we hit the center line, we sell, small size, take profit at the lower boundary on the triangle, or some kind of a channel or moving average. But the lower boundary of the triangle is fine. Sell 61.8%, 50% under this triangle, always take profits at the lower boundary. So we could have counted 2 weeks, 10 days, but this is of course now before the fact, after the fact, so it's too late for this. We expect a breakdown now. Okay, so we hold a position all the way to 18, or across the weekend, of course, you would not have a target. Now, we were looking at that 4 hour chart to see what kind of entry we could do if we're not already in the market. And according to this, we know that if we are correct, the market shouldn't really be moving above that yellow line. See, just hairlines above that yellow line means we can still get an entry at 29,275. 12,225, these kind of levels. Let's take this to now 15 minutes and 1 hour to see the internal pivots so that you know. Please relate with the 15 minutes. So 12,290 is the moving average, and you need to relate it to resistance ones because you are at the pivot. So resistance ones come at 37,500. Relating it to resistance one mean we would be selling around 50% of that 50% between the pivot level and it's the same yellow line here. 29,490, but in order to get into the market, you really need 29,300 and 29,290, whatever the price is. So in reality, this shows that we're holding. We would want to have a hedge next week at 31,000. We used to have a hedge at 32,500, but you can see we shouldn't really be moving above that level C. This is a forward chart. This level C is 30,700. So if you break above that level C, you are really breaking above a neckline and having some kind of, instead of a symmetric triangle, you're having an ascending triangle. So 31,000 is the hedge zone. If you get to see that, we open automatic. That is of course on Monday. Hedges will not work across the weekend. I don't think so. So on Monday we would instill that hedge. Going into the weekend, we take off the hedge on the platform so that it does not get filled at high levels if the market, unfortunately for us, moves